I have been inundated with just floods of various narratives of whether this market is going to be going up or down or more sideways chop or whatever the case may be. So I figured I'd come on here today, have about a 35-page deck. I'm going to be showing you some very interesting correlations that are going to be incredibly important to watch, especially this week as we have inflation data coming out, which is going to move bond markets. And then on top of that, I'm going to give you exactly what the market's pricing in, and we're going to break it down from a very unbiased point of view to demonstrate what's really going on in these markets and to be prepared for what may happen next. All that and more on today's Stock Market Brief show. Once again, I got to thank my partners, Interactive Brokers. If you haven't checked them out, click the link there below and check it out. They have a Interactive Brokers campus. By the way, if you haven't checked that out, make sure to do because they have free courses from beginner to advanced. They got podcasts. Their blogs are a killer. And then also thanks to my patrons that support me for the $9 a month or for the year. It's ends up being $7 a month or so. They pay get $90 and they get access to a bunch of benefits. Let's go ahead and get into today's show. All right, y'all, welcome back to the show. I'm going to talk about some interesting stuff here. Once again, if you don't follow me out on the Twitch sphere, I've been doing some live streams there. I do plan on doing them back on YouTube again. I'm just trying to figure out this software that I'm at, but I've been doing quite a few live streams. So if you haven't followed there, make sure to check out the Twitch. It's just figuring out money. And I typically post it out on Twitter when I go live or in the Discord and so forth. Okay, the reason why I bring that up is because I was live today and we talked about some of this stuff. So I want to kind of dive more into that today. Now, this is a chart of ES. And you'll notice that I have some lines on the chart, mainly these white ones, and then I have some red and green lines indicating higher highs, higher lows, lower lows, etc. Now, really since November, even longer, right, October-ish, we've been in this just a choppy range, right? This just volatility, high volatile range right within this realm. And you can see when we come up to the higher ends over here, we get shot back down. It's quite aggressive. We've seen over here, we've seen a quick aggressive move. When we broke back down into the box, we got pretty aggressive. Even right here, boom, aggressive. Right here, boom, aggressive. Even on Friday's trading session, we rather got quite aggressive to the downside. Now, excuse me, when I zoom out and we look at this, what are we seeing? Well, we're seeing the series of lower highs and lower lows. Then we started to see a little bit of pressure to the upside, giving us a higher reading and a higher low. And then in the near term, we saw a little bit lower of a low here. So this could technically be another step down here. And then we saw a lower low. So we're really just getting very tight here. Now, overall, from a year-to-date VWAP perspective, we are holding above that. We actually came down in there in today's session on futures, which is the middle of the range, about 6,000, and we started to close up there at around those highs. So the thought here is, as the market's trading in this range, we want to be prepared for if and when we eventually break out of this range and where it could potentially lead us to. And when we break from this range, what the market may entail. Now, here's some interesting data about really this year as far as expectations of risk go. So this right here is a picture of the SPY. I'm dating it back to 2025, the start of 2025. And you'll see we've had 1, 2, 3, 4, 5, 6, working on 7 trading weeks, not full trading weeks, but weeks within this year so far. And there's something very interesting here. What I've noticed is each of these weekly expected moves, this is what the market prices in for the week ahead. Okay, so we get it on Friday, Saturday, and it's telling us what the market's expectations are for risk the next week. Incredibly useful information. One interesting tidbit here is if you go back a few years, even longer, 4 or 5 years, and just calculate all the expected moves, there's about still, with the SP 500, SPX, SPY, about a 75% probability that we're going to be tagging the upper and or lower any given week. This year alone, you can see we tag the lower, okay? We tag the lower, we tag the upper, we tag the upper, we tag the lower, we tag the lower. So actually, out of every single week, full completed week so far this year, we have hit that implied move. Now, what you'll notice here, we have this week is about a $9.70 move, which means that we're looking at plus or minus $9.77. The prior week was 10.52, right? Then we have 8, we had 11 over here, which is going into presidency, coming into office, the inauguration, and then we had 8 and 8. So right now, the market, interestingly enough, out of those 7 weeks, as completed weeks, 3 of those, 50% of them, the market's incorrectly managed to handicap risk, meaning that we broke and we closed outside of their expectations. So the market has been a little all over the place, really trying to grasp what can lie ahead. Now, this week, we got a lot of stuff going on. And I'm saying this because last week we had a $10.52 expected move. This week, we still have roughly a $10 expectations of a move, which is a large move for the week, which means that we're still open to coming down here. I'll give you more specific levels later, or up here to 977. For the month, the monthly expectations was 623.26 and 580.38. Now, if you were watching the prior month, we did come into that and we found some resistance at those specific levels. So we still have more than half of the month left and we have a wide open move. So there is still a strong possibility that we can come tag either of those levels. Okay, so that's some interesting data that's been going on, meaning in short, the expectations for potentially coming up here or down here are increasingly high. We closed here last week, so we started with a little bit of an inside candle after Friday's sell side. So if we start breaking the high and we start moving outside, that opens the door for up to these levels. If we start breaking down from these levels, I mean, that opens the door right back to test these lows and potentially follow through to the downside. If you zoom out now and look at a weekly chart, what do you notice, right? We had this big bullish outside body, right? And it led us to see some more upside price action, right? When you get far extended from this weekly 5 EMA, it's very typical to see rubber band type snapbacks, right? Over here, we snapped back. Over here, we snapped way through, and then we came right back. Same here, we came way down, we snapped back. And then we came up here, and what happened? Well, we snapped back. So right now, as price has kind of just been consolidating this recent bullish candle, we're still holding above an inclining weekly 5 EMA, and we're above the prior week, which is positive too. So we're starting the week so far rather bullishly in this current context, right? We'll talk about some of the bearish stuff going on, but if you zoom out and look at the larger picture, it's pretty volatile. It's all over the place. We're getting tape bombs left and right through various posts and information around DeepSeek and tariff bombs and etc. But this is all part of that bigger picture to really kind of hone in on stuff, right? If you zoom and you look at the SPY and you look at the daily time frame, I mean, this doesn't look horrible, right? We've just been kind of consolidating. We recently broke out of here. We came back to back test it again. We came back again. And right now we're kind of just trading sideways, tightening up, which we're not even 1% away from all-time highs. So this is more of a bullish consolidation, albeit we are seeing distribution type days. Now, a distribution type day means you get a down day on higher volume than the day prior, right? So that would be considered a distribution type day, just a strong volume down day. If you take a look at the Qs, right, it's just been consolidating sideways. It's dealing with a lot of news and it's trying to kind of work itself through this period in time in this range. You're either getting very chopped up or you're just kind of on the sidelines waiting for conditions to get a little bit better. And this is where it kind of comes into from more of a step away from the market for a bit and start to look at intermarket correlations. I've shown this chart many times, right? Where if the dollar goes down and the 10-year yield goes down, it's been very beneficial for the S&P 500, right? Here's the dollar, 10-year yield, S&P 500 down here. And when sometimes the dollar goes up and the 10-year yield goes up, it's not been beneficial for the S&P 500. More recently, you can see that pop in the dollar here, the pop in the 10-year yield going into year end there, and the S&P 500 went through a minor pullback. Now, in recent trade, the dollar, right, has been coming down a little bit, rather choppy, but it came down from its high in 2025. And then over here, from the 10-year yield peak over here, it's coming down there too as well. And what's the S&P 500 doing? It's right there at around all-time highs. So the correlation that I find very critical here is going to be right over here at this 10-year yield. And the reason for that is simply this chart, and I'll build on it. But the 10-year yield has been kind of pulling in slightly over here after, right, a big move, and then it also consolidated over here. But the correlations amongst various assets, specifically the S&P 500, so you can see it right over here. This is where it's at. It's at minus 0.7, which tells me it is a strong negative correlation. So when it's under the zero line, right? What does that mean? If the 10-year yield goes higher, right? And especially if you see a stronger move to the upside, it could very well hurt the S&P 500. Okay, nothing new there. If you look at the NDX correlation, that's also a negative correlation at minus 0.62. And then you have the IWM down here. It's been at a negative correlation at minus 0.73, which tells me one thing. The 10-year yield is going to be an important asset to watch, because if we start seeing it rip back up to the upside, it can very well hurt our markets. Now, if you look at Bitcoin, there's really no correlation at the moment right now on a 20-day rolling basis. You have a negative correlation also on KWEB, which is China equities, and then HGX, which is the housing index. We usually have a negative correlation there, but in this current context, not much of a correlation whatsoever. So when I pull this chart up, this is the 10-year yield amongst the bridge bands. Okay, this is a indicator created by Joe Catt. It's just a form of bands that are spawned quicker than Bollinger Bands. And we have a zone, we have a trend indicator right over here to give us an idea of when the trend could potentially change. And you can see over here, it was red turning to green, right? So this is when we went into more of a bullish trend, okay? And you could see since that point when we started flipping bullish, every time that we kind of just grinded the bands higher. When we came down lower to it, the lower bands, we came back up. And then now, what do you see? Well, we're pulling in to these lower bands, which was the other day, and we saw ourselves bounce a little bit. But this is kind of flirting with a trend change, meaning that we're kind of at this neutral stance. And as we're at this neutral stance, one thing to notice is the upper band has been pulling in well off the highs, okay? The lower band is now pulling itself down beneath the trend, which indicates that momentum here, right, is shifting to the downside. So if we were to bounce, there is still upside to and around currently. These are dynamic bands. They're always constantly changing, but 4.62 on the 10-year yield. And if we bounce up but continue back and we break trend and this pulls lower, right, that could negate the scary stuff going on in the markets potentially, right? It's all about how fast these assets move. But right now, we're kind of holding in. Today we had an inside trading day, and we're back to a shorter-term bullish trend, and we're not too far off the lower band. So this is something to pay very, very close attention to. And more specifically, the reason why I'm talking about the bond market right here and yields is because we got inflation data coming out here, and we have Fed Chair Powell's testimony. So tomorrow the testimony starts. The next day on Wednesday, it continues, and we get inflation data an hour before the markets open up. And when we get inflation data, you typically see the bond market respond and react. And that's going to be critical for us to obviously continue to watch. Now, why would it be important to watch 10-year yields? Or why would it be important to watch potentially another asset that has a strong correlation to 10-year yields? I'll show you. Oil is an incredibly important asset, right? We're talking about inflation. Well, the rising cost of oil, right? If oil goes up in price, right, that can very well increase inflation concerns, and inflation can easily go up, right? It's oil. Now, the reason why I bring up oil next to a chart of the 10-year yield, which is right here, that's the candlesticks, and oil over here, which I've shown many times, is because oil can be a leading indicator of where the 10-year yield will very well go. So, for example, over here in April, right, oil came off. Shortly thereafter, what followed? The 10-year yield. Okay, well, right over here in early September, oil found its bottom. Very shortly thereafter, about 7 days after, the 10-year yield found its bottom. So the thought here is, hey, if oil, right, it bounced up today, right, it came up a bit today, if it continues to rip to the upside, it's very likely that the 10-year yield goes and tries to attack that upper band over here at around 4.6. Okay, now why would that be important to understand here in the broader context of things? Because of this. Take a look at crude oil, right? So this is crude oil. It was up 1.86% today. Now look at its correlations amongst these assets. This right here is its correlation to the 10-year yield. We just saw that here. They move hand in hand. But what is the 20-day rolling correlation? This isn't me making it up. We have a positive correlation currently at 0.8. Meaning that these things are moving at a very positive correlation right now. And it's usually in a positive correlated state. You'll have periods and times where it's not, okay, because correlations constantly change. But at this current moment, if oil goes up, there's a high probability that the 10-year yield follows that path, okay, because the correlations are so tight. Now, why would that be important to know? Well, because oil is also very correlated to energy stocks. So for example, XLE, what's the correlation between oil and energy? Well, it's at 0.74 right now. Okay, so if oil moves up, energy stocks are most likely to move up. Now, why is that not necessarily a good thing for markets? Well, that would be this line down here. Now, this is looking at the correlation between oil correlated to a relative strength line of SPX, so S&P 500, relative to XLE. So what does that mean? It means that if oil moves higher, and this is a negative correlation, it means that the SPX underperforms energy names, right? Very simple stuff. It's a negative correlation. And what did we see today? Well, today, right, it doesn't make a trend, but energy led the way. It was the top performing sector. It was up 2.2%. Zoom out a little bit. What's it look like year to date? It's not too far off of being a leading sector in the S&P 500. These are the 11 sectors that make up the S&P 500. They're kind of all over the place. There's not really a clear risk on, risk off look here, other than technology and consumer discretionary, both risk on assets, are towards the bottom. But you can look at consumer staples and be like, well, that's a risk off asset. Why wouldn't that be more up here? Well, we got focus on financials and we got healthcare, right? And then energy has been leading the way. So it is a little bit of a mixed board, albeit everything from a sector standpoint, from a year-to-date basis here, when I pulled the data, was positive on a year-to-date basis. Now, if I show you the specific chart, this right here is XLE, right? XLE, right? Relative to the SPX. So I'm just switching this around here so you can kind of see what this chart might look like. When this line goes up, right? What does the S&P 500 do beneath us, right? This tells me energy is outperforming the S&P 500, right? Line go down, right? It outperforms the S&P 500. It's not good for the S&P 500. You get a quick spike to the upside where energy outperforms, S&P 500 pulls in. Okay, even recently, right? Going into 2025, just right there, we saw a spike in that relative performance and it took the market okay, now right now, what are we doing? We're kind of just chopping around sideways, right? So the point here is simple. You got to watch the oil, right? For one, you got to watch oil, which has inflation. It has the ability to change the rate at which inflation potentially goes higher and or lower, especially at the rate at which the price of oil moves. So a rising cost of oil, right, could increase inflation expectations. And on top of that, looking at oil and watching oil and how it correlates to the 10-year yield, which we just recently shown, is also a good indication that it can very well hurt the markets because inflation, right, picks up. Well, 10-year yield can there follow, or inflation expectations potentially remain higher. And then we know that that can very well hurt growthy names, which we just shown on those charts. Another interesting aspect to all of this, as we're about to get inflation data, is copper. Like, what is copper doing? Copper just shot off 3-4 days in a row vertically up to 4.7. And this is interesting to me because, well, copper one has a very nice tight correlation, positive correlation to China equities. But if you have copper rise at this rapid rate of change, like, this is also an inflationary metal, right? The higher the cost of copper means what? Well, the higher cost of many things from an economic standpoint, because it is an economic metal. In fact, they call it Dr. Copper because it has a PhD, right, in economics. So what else has been kind of going on? Very interestingly enough, we've seen the housing market not really recover here in recent trade on the shorter term. You've seen a lower high while the S&P 500 marked a new high. And this is important. I think the longer the divergences go, the more relevant that they actually are. For example, if you go back to 2005, that's when the housing market peaked, but the S&P 500 went higher for a year and a half. But that was an early indication saying, hey, something's a little off here, because housing is a huge component to our economy, to the U.S. economy, to economies around the world. And what do we see here on the shorter term basis? Well, you could see that housing over here going into 2022 never made a new high. It made matching highs. And then you had the S&P 500 that entire time pressing higher and higher and higher while this market diverged. And what did that lead to? Well, it led to the bear market of 2022. Now, on the flip side of that, S&P 500 in October made new lows. What did the housing market do? It didn't make new lows. It actually put in a higher low, diverging, telling us and indicating to us that, hey, perhaps things might be changing in these markets. So I think it's going to be important to watch this and see how it relates later into the markets. So if at anything, I'd want to see the housing market consolidate and potentially head up higher. But if this thing starts to see more weakness to the downside and the market's kind of just doodling on higher, I do not believe that that is a divergence, right? That can last a long time without seeing, that kind of come back into correlation. If you take a look at value line geometric, and so more like equal weight, it's also put in a high here, lower high, where the S&P 500 put in a new high. And since that point, right, what's the S&P 500 been doing? It's been chopping around sideways. So you want to see breadth re-enter into these markets here too as well. We can call it out over here. Then we saw a little pullback, right? Over here, right, we saw a steeper pullback. That was the correction. And then there's even littler divergences over here that led to some sell side activity. Now, this is also happening with the put to call ratio at a very bullish reading. We started to cross back above 0.8, which indicates more of a sell signal crossing from underneath it to above it. And what happened to the market? It kind of stalled out, saw some weakness, kind of going around sideways. So if the put to call ratio wants to come down further here, that would just be more caution, saying that sentiment's getting a little too extreme here from that perspective, and you could have very well counter trend moves. Now, on the flip side of that, if this starts picking up right now to the upside, that's also not the greatest sign, as we've seen when it picks up, right? We've seen the market see turbulence, right? Another interesting indicator that I like to use is the Sailor to Shift tool, and that's looking at the relative strength, the rate of change between the 4 weeks Bitcoin and gold relative strength ratio. And last week or 2 weeks ago, we had the sell signal trigger, and then the official trigger happened last week. And right now, like we're basically an unchanged signal, but it is still basically pointing straight down at this current time. So I'm just waiting for the next buy signal to come in. Now, this is not to say that we can't whipsaw right back and the market goes higher, but what I will say is this indicator, this rate of change has caught in every big move to the downside in crypto before it happened. So if you go back and look at the history, every time that we slipped into a negative rate of change, right, and the price action crossed below the prior week, it caught every single big dip in the market. This one, that one, and it's also caught every big rip, including this one going into 2021, including this one over here in September of 2023, and then back again. And then you deal with various amounts of whipsaws while you have the market consolidate. So we're seeing that right now. Now, interestingly enough, this is happening while gold is breaking out once again to new highs. And, I started this saying, like, nobody knows really what's happening next, but what is gold doing? Like, what is this telling us? Is it telling us that, hey, there are strong inflation concerns, or is this something to do with tariffs? I don't have these answers, but what I do know is gold has been monstrous. It's been moving straight up, and this is something that we got to continue to monitor, watch, see how it consolidates. This has been a very, very big bull cycle here for the price of gold, as we've just constantly been hitting new highs. It's actually, interestingly enough, one of the top performing products in the market space, right? Here's where 2025 started. We're way up here. So when gold outperforms the S&P 500, right, that's also not the greatest sign for markets. So very just overall, very interesting stuff in these markets taking place. Now, if I look at Bitcoin by itself, right, very interestingly enough, we had that sell signal, sell trigger. Overall, it's just going sideways, right? So, hey, perhaps we pick right back up and start moving. But I will say this higher high, we have like a RSI that is diverging. Okay, whatever, right? Perhaps that's a double top if it crossed underneath this and it heads lower. But one interesting thing is if you look at the relative strength line between Bitcoin and the S&P 500, we haven't actually touched and crossed the 50 period EMA for quite some time, right? So we recently crossed under it, which can indicate more weakness ahead, right? Why? Because it just tells us the S&P 500 is performing stronger. Right now, it's currently flatlined, but it did cross under. The last time we crossed the 50 EMA was over here, and we had some choppiness over here. But if you just go straight up, I mean, that was a great indication of breaking out and heading a lot higher and a lot quicker in the price of Bitcoin. So is this the start of this potentially flattening out to rolling over? Well, if this starts breaking down, I think that would, obviously be an early indication of, hey, watch out. So applying this and utilizing the Sailor to Shift tool has been rather helpful. Now, there's a lot of obvious interesting things going on from an inflation perspective, right? Like I said, we're going to begin these inflation numbers. When, right? An hour before the markets open up, consensus is basically saying core inflation is at 3.1, inflation rate year over year is 2.9. There's many various people that have been reporting data saying it's going to come in higher than expected. If it comes in hotter than expected, probably not the greatest sign for markets, right? If it comes in cooler than expected, probably the markets are going to love it. If it comes in at consensus, well, the market's probably priced that in already, okay? So not much to go on. We can just look at those expected moves and go from there. Now, with all this taking place, there are some positive things that are happening in the market, which tells me you got to be prepared to be involved in it and then step away if things change. What am I talking about? I'm talking about where we stand with the gamma flip line, right? So the gamma flip line, I look at two things when it comes to market conditions: direction of the 5-day moving average and the gamma flip line. Right now, we're in positive gamma territory, not by much, and we haven't been by much. It's been more neutral and then goes negative, neutral, negative, and call a spade a spade. We are in positive gamma. What's that mean? Dealers look to buy the dip, sell the rip. Where's the upside to all of this where we can potentially run into problems? First and foremost, it's been that 6,100. We already called that out in the beginning of this episode. If we start breaking and seeing a push higher and higher, the call wall is at 6,200. And we have the JPM collar, which lasts another month, right, until they roll it. And we get the new position is up here at about 61.65. So here, if you are bullish, right, above 6,000 or above this gamma flip line right here, right, in these areas, if you're bullish above this zone, I would be targeting right up here for the remainder of the quarter. That's where I'd be looking, because when you run into this collar, you have dynamic hedging kick in. It could put a ceiling to the S&P 500. It's a large position. But if we can break through that and we go strike where traders are focusing, which is 6,200 via gamma, we could very well be in and around this area in a very short period of time, breaking out of that box that we talked about here as we've been kind of just coiling up. Okay, so that would be the bullish perspective. Now, from the bearish perspective, like I said, there's many things lining up to be bearish, but that's what I would say is as long as we can hold positive gamma territory in this 6,000, I'd be bullish above to go these areas. If we start breaking down into negative gamma, I'm not interested. When I look at the 5-day moving average, it's been rather flat, but wait, we're green on the SPY, green on the Qs, green on semiconductors, right? We're getting back above the year-to-date VWAPs, the blue lines. XBI is showing some weakness. WM, it's flat. DIA, taking a consolidation here too. To add more bullish context, CTAs, right, have started to pick up buying pressure. So CTAs, if we start breaking through this range that we identified earlier, CTAs could become big buyers, really forcing this move to the upside. And that would be something that we would want to pay attention to. Okay, that was a lot. I went over a lot, and I got still quite a bit to go over. I wanted to talk about expected moves for the week, the specific levels, and then the daily expected moves. So for the SPY, right, if you want to screenshot this, go ahead and do it, and you can put these levels on your screen. But tomorrow, we're looking at a move to and around 608 all the way to and around 610, which can bring us right up to the upper weekly implied move at 610.54. If we start breaking down, I would be looking right back down at these 598.83, 601. This would be the lower zone that the market's pricing in. So we got a pretty decent sized range of risks there. If we do come into these areas, we'd be back below the 5-day moving average, but we would still be holding that year-to-date volume-weighted average price, and that's going to be critical. You can see here on the Qs, right? If we start to break to the upside and hit the daily move, right? By the way, this right here was the daily range today. And we were there. We got outside of it a little bit, and it was like right here. We got outside of it, we came back in, we got outside of it, we came right back in, so doodled around. So if we have a similar day, right, we can be right up in this range, right back at that upper weekly implied move. If we see some weakness, start to pay attention to these lower levels right down in here. We'd still be holding the year-to-date VWAP, but we'd be underneath the week-to-date, and we'd be right there underneath the 5-day moving average there too as well. So it still would be more cautionary than anything, and we'd have to see how it sets up there intraday. Now, as I'm looking at the Qs, I did want to talk about potential opportunities in a name that's been getting beaten up, but I also want to provide more context because in order for the SPY to move higher and the Qs to move higher, it would very well behoove us, the bulls, if the Magnificent 7 names, started to see some strength. And right, there's most of them, right, are below their year-to-date VWAP. And being below their average volume-weighted price for the year is not a great sign. So it needs to recover these levels. Look at Apple. It's underneath it, okay? So there's one. NVIDIA just crossed back above it today after a very strong snapback. So that's positive, but it wouldn't be positive if it starts falling back underneath it. So that's a good sign to see that. Microsoft. we're sitting around lows of the year, and we're well below that year-to-date VWAP. So it'd be nice to see that recover, right? So there's two. Amazon, we went and tested it off earnings. Today was an inside trading day. We're holding it. So as long as we can hold it, Amazon looks like it can start to move back up and retest these highs. That would be a good risk to reward trade right there. Back to the upside. But if it starts breaking down, then just be significantly more cautious. Now, if Amazon starts to pop back up to all-time highs, that could very well benefit us and these markets, right? Google, at least if you're bullish. Google, this one, bearish earnings move, and we're getting some follow through to the downside, and we're below that year-to-date VWAP. So another one that's kind of broken down here. Now, interestingly enough, if I pull up the weekly implied move for Google, 191.36 to the upside, right? 179.32 to the downside. But this level right here, this is what was priced in for the month of February. And actually, we're right here. So when this happens, if I see continued sell side in Google, I would just take the probability bet to head higher. Now, personally, and I'll show you a name here momentarily, if we get a quick snapshot down there, right? Because it's February 10th. I don't want to go long February 24th, right, to potentially see a move back up to the lower monthly implied move. But sometimes when you get a very fast snap down and you're below a key level, there's a high probability that we see some sort of a reflexive bounce after already significant selling. And I'll show you that one here in a second. Now we have Meta. Meta has been on an absolute tear. That's also above its year to date. Now this is going to have to consolidate and pull in here at some point. So we'll see when that is. Potentially in the near future. And then the one that I wanted to kind of talk about here was Tesla. So Tesla is also one that's below its year-to-date volume weighted average price, and it's getting just hammered, right? It did this also last year, right? At the beginning of the year before running 240% up from its lows. So Tesla closed at the low today, closed at the low on Friday's session. And what I want to call out here is as this sell side action is increasing here, we just recently today pulled into the lower monthly implied move. Now, once again, if you think of things in terms of a distribution curve, at 68% of the time, we'll close within that. And we're starting to crack under it. So my thought here is not only are we at the lower implied move after today's price action, we're almost near the lower weekly implied move, which we cracked through yesterday, right? So if we start to really press here tomorrow and get under it, I'm probably just going to take a probabilistic trade in and around 335 to 338 and just hold it till the month end, unless if it stops me out by a wide margin, but take a little shot to see potentially move right back up into the monthly implied move for 30, 40, 50, almost $20 a share right there. All right, that's all I got for you on today's episode, everybody. Hope it helps out, gives you some insight into these markets. I'll see you on the next.